start with this idea of a secret language, one that's hidden in plain sight, in the constant flow of the financial markets.
It's all around us.
It is. We're talking about the movements of price, which are really just the visible result of this huge psychological battle between fear and greed. Now, imagine for a moment that you could actually see into the intent of the biggest players, the banks, the hedge funds, and you could understand their next move just by looking at a chart.
It's the difference between, say, hearing a crowd roar and knowing exactly why they're roaring. You're moving from just watching the price go up and down.
Passive observation.
Right, to active analysis, where you really get the context and the reason behind the movement.
Today, we're doing a crucial deep dive into the history and, maybe more importantly, the tactical application of what is arguably the most powerful visual trading system ever made, Japanese candlesticks.
And our sources for this are really comprehensive.
They are. We're leaning mostly on a source known as the Candlestick Trading Bible, but we're also pulling from a few other expert guides on modern price action.
What's so fascinating is that unlike a simple line chart, which, it just plots one data point like the closing price,
Right.
a candlestick gives you a complete snapshot, the open, the high, the low, and the close, all for that specific time period.
And that depth of information, which was developed centuries ago, is so important because human emotions, fear, greed, hope, they just repeat.
Constantly.
And that leads to these identifiable patterns that you can actually quantify and to some extent predict.
Our mission for you then is to translate this ancient, profitable method into high probability, actionable knowledge.
Exactly. We're going to decode the anatomy, we're going to explore the market psychology behind the patterns, and we're going to introduce this concept of confluence.
Which is the secret ingredient, really.
It is. It's what turns visual analysis into truly high probability trading decisions. Our goal is to quickly get you that critical skill of reading charts, the actual language of the market, without you feeling overwhelmed.
Okay, let's unpack this. And we really have to start with the origins, because the story itself gives you the whole philosophical reason for why these charts even work.
The story begins back in 18th century Japan with a man widely considered the most successful trader in history, Munehisa Homa.
Munehisa Homa. He was born in the early 1700s, traded rice, and he got so good at it they called him the god of markets.
The god of markets. I mean, think about that.
And his discoveries, which basically laid the foundation for candlestick charting, they're estimated to have earned him a fortune equivalent to more than $10 billion today.
$10 billion. That's just a staggering level of success from a single analytical system.
And it all started with rice.
It did. Rice trading completely dominated Japan in the 17th and 18th centuries. Our sources say it was literally more important than hard currency.
Which created this high-stakes environment. It pushed them to develop these incredibly sophisticated exchanges, even early forms of futures trading.
Yeah, this wasn't just simple spot trading. The complexity was, it was really something else. I mean, derivatives developed so early on.
They did. For example, by 1749, the exchange was trading 110,000 bales of rice in futures.
And how many actually existed in the country?
Only 30,000. So you had this booming, sophisticated derivatives market that needed an equally sophisticated way to track prices.
And Homa, he obviously understood supply and demand, but his critical multi-billion-dollar insight was recognizing that the market wasn't just rational.
Not all.
He saw that emotion, specifically the crowd's reaction to news, their fear, their panic, it played this huge, measurable, and predictable role in setting the price.
Exactly. That was the core of it. His work focused intensely on tracking the emotion of the market players over time, and that became the psychological engine of candlestick analysis.
He was so respected that he was actually promoted to samurai status.
An unbelievable honor for a rice trader. I mean, that just confirms how powerful his system was perceived to be.
It's pretty remarkable that a tool this powerful just remained a Japanese secret for centuries. I mean, it was the world's best-kept technical secret until, what, the late 1980s?
Yeah.
Why did it take so long for the West to catch on?
Well, it was a mix of things. You had cultural isolation, and the exchanges were just very specialized. It wasn't until the big global banks started cross-pollinating in the late 20th century that Western analysts finally got wind of these unique charts.
And we credit a couple of key figures with bringing it to the West. A man named Michael Feeney. He was head of technical analysis for Sumitomo in London. He was one of the first.
But the person who really globalized it was Steve Neeson. He was a technical analyst at Merrill Lynch in New York. In 1989, he published a paper in Futures magazine.
Ah, I remember reading about this.
And he detailed these core candlestick reversal patterns, explained how they worked. Then he followed up with a definitive book in 1991 that just blew the doors open. He translated the whole method and made it a modern standard.
Which brings us to the core question. Why did they become the standard? Why do basically all modern traders work from this template?
Because they're just objectively better for reading psychology than a line chart or a bar chart. They give you a visual picture of market sentiment. You're getting those 4 key pieces of information open: high, low, close, all at once.
You're not just seeing where it closed.
No. You are literally seeing the visual record of the battle that led to that close. You see the failed attempts by both the buyers and the sellers. That level of clarity is just unparalleled.
Okay, so let's get into the language itself. The anatomy of a single candle. And remember, a candle can cover any time period you choose. 1 hour, 1 day, 1 week.
And every single one has 2 main parts. The real body, that's the thick rectangular part, and the shadows or wicks, the thin lines sticking out from the top and bottom.
The body tells you about directional strength, right?
Right. The body shows the range between the open price and the close price for that session. If the close is above the open, the candle is bullish. We usually see that as green or white.
And if the close is below the open,
Then it's bearish, usually red or black.
the size of that body is pretty important too.
It's crucial. A long, fat body means strong conviction. One side, the bulls or the bears, was firmly in control and pushed the price a long way. They won that battle decisively.
And if you see a short or small body,
That means there was little conviction. It's often a sign of equilibrium or just the market taking a rest.
what's the ultimate expression of conviction then? Our sources talk about the Marubozu.
Ah, the Marubozu, the shaved candle. In its purest form, it has no wicks at all, no shadows.
So a long Marubozu represents a huge range and just strong, uninterrupted conviction from one side for the entire session.
Exactly. If it's a bullish Marubozu, the buyers pushed price relentlessly from the open, which was also the low, all the way to the close, which was also the high. That's powerful momentum.
Now, this is where it gets fascinating for me. The shadows. They tell a deeper story, a story of rejection.
Yes. The shadows are not just markers of the extremes. They are evidence of failed price attempts. The tip of the upper shadow is the high, the bottom of the lower shadow is the low.
And if the shadows are short, that means trading just kind of stuck close to the open and close.
Right. But if the shadows are long, that's where the story is. It means there was significant trading way out at prices far from where the candle actually closed.
Which suggests a powerful rejection of those levels.
A very powerful rejection. Let's break that down psychologically. Imagine a candle with a long upper shadow and a short lower shadow.
Okay.
This tells us that early on, buyers were strong. They pushed the price way up. But before the session ended, sellers came in with overwhelming force and drove the price all the way back down to close near the open.
So it's a signal of strong selling pressure. Resistance.
Absolutely. That upper shadow is literally the graveyard of all the buyers who tried to push the price higher during that period, but failed.
And the opposite. A long lower shadow with a short upper one.
Same story, but in reverse. Sellers initially forced the price way down, showing their dominance. But before the close, buyers rejected that low. They pushed the price all the way back up to close near the high.
A clear signal of strong buying pressure. Support.
Exactly. And the longer that shadow, the more powerful the rejection and the more significance you should give that reversal attempt.
So moving from single candles to patterns of 2 or 3. This is where we start simplifying these complex market dynamics. These patterns are so important because they just show the repeated emotional reactions of people in the market.
And we should start with the ultimate signal of market confusion, the Doji pattern.
Its definition is simple, right? The open and close are pretty much the same price.
Right, or very close. So the real body just looks like a thin line or a cross. The psychology is immediate, total indecision. Neither buyers nor sellers won that session.
But the signal is all about the context.
Always about context. When a doji shows up at the top of a strong uptrend or the bottom of a downtrend, it's a huge warning sign. It says the previous trend is losing steam. A reversal is likely.
And its variations tell us more about the battle. The dragonfly doji, that's the bullish one.
Yes. It has a long lower tail with the open, high, and close all bunched up at the top of the range. That long tail shows that sellers tried to drive the price down.
But they were rejected.
Powerfully rejected. Buyers pushed the market right back up. It's a very strong bullish reversal signal, especially near a known support level.
And the inverse is the gravestone doji.
The bearish version, a long upper tail with the open and close at the bottom of the range. Buyers pushed price high, but sellers completely overwhelmed them and forced it back down.
So it indicates the bulls are losing their momentum.
They've lost their conviction. It suggests a bearish reversal, especially near resistance.
Okay, now let's get into multi-candle patterns. These often carry more weight, right? Because they show a shift over multiple sessions.
Absolutely. And before we get specific, we should introduce the professional term pin bar. A pin bar is really just a catch-all for any candlestick with a small body and a long wick that signals rejection. The hammer, the hanging man, they're all specific types of pin bars.
Got it. So let's look at one of the most decisive patterns, the engulfing bar.
A very reliable two-candle reversal pattern. The second, larger body, has to fully engulf the body of the previous candle. And crucially, the colors have to be opposite for it to be a reversal.
So a bullish engulfing pattern would be a small red candle followed by a big green one that completely swallows it.
Exactly. And psychologically, think about what that means. Every single seller who was active in that first session was completely overpowered and absorbed by buyers in the second. It's a total immediate shift in momentum, a very powerful reversal signal at the end of a downtrend.
And the bearish engulfing is the opposite, a small green handle followed by a huge red one. All the buyers from the first session just got overwhelmed.
Yes. If you see that at a known resistance level, it is one of the highest probability setups you can possibly find.
Okay, let's go back to that pin bar family. The hammer and the hanging man. Structurally, they look identical.
They do. Small body, long lower wick, at least twice the length of the body, and almost no upper wick.
The context is what gives it the name and the signal. If you see this pattern in a downtrend, it's a hammer, and it's strongly bullish.
Right. That long lower wick proves that sellers tried to push the market way lower, but they lost the battle. Buyers came roaring back. The key is that the final close is near the top of the range, showing buyers were in control at the very end.
But if that exact same shaped small body, long lower wick, appears in an uptrend, it's a hanging man, and it's bearish. Why?
Because the presence of that strong selling pressure, the thing that created the long lower wick, suggests that even though the trend is technically still up, there's major distribution happening. Buyers are struggling, the sentiment is changing, and it's pointing to a reversal down.
Okay, finally, let's talk star patterns. These are highly reliable three-candle patterns. The morning star is the bullish one.
It starts with a big bearish candle where sellers are in control. That's followed by a small, often gapping down candle. That's the star, which shows indecision.
Right.
And then it's confirmed by a big bullish candle where buyers take back control.
That little star in the middle is the key.
It shows a sudden, total lack of follow-through from the sellers. The evening star is the bearish version. Big bullish candle, a small indecision star that often gaps up, and then a big bearish candle to confirm the reversal. The conviction of the bulls just evaporates. It often marks a major market top.
Let's also touch on the harami pattern, or inside bar. The first candle is the big mother candle, and it completely contains the smaller baby candle that follows.
Right. Psychologically, this is consolidation. It's deep indecision.
But our sources say it's not very reliable on its own.
That's a critical point. The source material is very clear on this. While it can signal a reversal, it often just signals that volatility is contracting. It doesn't necessarily mean a reversal is coming.
So if it's unreliable, is there a time we should just ignore it? Or should we always just wait for more confirmation when we see one?
That's the right question. You should stand aside entirely if the mother bar is very small. If the harami forms at a major proven support or resistance level after a long move, it's worth watching, but you must wait for a definitive breakout.
And if it's just in the middle of a chart with no context?
It's just noise. Ignore it.
Yeah.
The market is just taking a breath. And trying to predict the next move there often leads to losses from the tight, choppy trading that usually follows.
Okay, so that brings us to the next critical piece. If candlesticks are the language.
Then market structure is the map and the compass. This is the foundational skill. It determines which of those candlestick signals you should even pay attention to. You can't just apply reversal signals anywhere.
Reading the structure tells you what the crowds are doing and who is really in control on the big time frames.
Exactly. And our sources categorize the market into three main types. First, trending markets. And surprisingly, they only happen about 30% of the time.
These are the ones we want, right? Clear directional movement. An uptrend is a series of higher highs and higher lows. A downtrend is lower highs and lower lows.
And within these trends, the moves are cyclical. You have the impulsive move, which is the strong move in the direction of the trend.
And the retracement move, or pullback, which goes against it for a bit.
The professional traders know you never chase the impulsive move. You wait patiently and aim to enter right at the beginning of the next impulsive move, just as the retracement is ending.
Okay, the second type, which is often the most common, is the ranging market.
Sideways consolidation. Price is just bouncing between predictable horizontal support and resistance levels. Buyers equal sellers. It's equilibrium. That requires a totally different strategy.
And the third type is the one to avoid.
The dreaded choppy markets. No clear direction, just a lot of unpredictable noise. Price moves sideways in a very small, tight range. The sources are emphatic. If you see this, close your charts and walk away. They are not consistently profitable.
And this brings us to a huge reason why traders get trapped. They focus too narrowly on small time frames. This is really important for finding those high probability setups.
It's everything. The clarity of your price action is directly tied to the time frame you're looking at. The sources are insistent on this. Pin bars, engulfing bars, they work best on the 4-hour, the daily, and the weekly charts.
Why not the 5-minute chart?
Because the smaller time frames generate a massive amount of noise and false signals. They're recording the chaotic, micro-level battle. The bigger charts filter that out.
So you have to adopt the top-down analysis approach.
You have to. You start with the weekly chart to get the big picture, the overall structure, the major momentum, the strongest support and resistance levels. That tells you what the institutional money is doing.
And only then do you move down to your trading time frame like the daily or 4H to look for your specific entry signal.
Yes. And the power of that weekly level is absolute. We see this trap all the time. A trader sees a perfect textbook bullish hammer on the 4-hour chart.
Looks like a great trade.
But if that signal runs directly into a powerful weekly resistance level, a level that took institutions weeks to create, that 4-hour signal is going to fail almost instantly. Understanding the higher time frame context is the ultimate risk mitigation.
So we know the structure. Now we need to find the specific map points where we expect the market to turn. That's the role of support and resistance, or SR.
Exactly. These are proving areas where buyers and sellers have previously found equilibrium. They're major turning points that tend to contain price until they're broken.
And in a trending market, you find them at the swing points, right? The previous highs and lows.
Precisely. In an uptrend, the price makes a high, a swing high, then it pulls back. When it pushes up again and breaks that previous high, that old high now becomes the new support level for the next pullback.
And in a downtrend, a broken swing low becomes resistance.
Correct. That's how you predict where the retracement will end and the next impulsive move will begin. It's structural.
There's also this crucial psychological idea of the support-resistance flip.
Yes, or polarity change. When a resistance level is broken decisively, institutional memory kicks in. That former resistance often becomes powerful new support when it's retested. Price respects these areas because traders remember them.
Okay, what about trend lines?
They're basically dynamic or diagonal SR levels. When a market is trending clearly, price tends to respect a linear path. To draw a good one, you need to connect at least 2 swing points, and you have to draw them on the bigger time frames, like the 4H or daily.
And you can't force them.
Never force a trend line. If it doesn't look natural and obvious, it's not a valid level.
So bullish markets form a line of support. Bearish markets form a line of resistance.
And they help you anticipate the next impulsive move when price comes down to touch that line for the 3rd or 4th time.
What if you can't spot a clear static level?
That's where the 21-period moving average comes in, the 21 MA. The sources introduce this as a key dynamic SR level.
Why the 21 specifically?
Because it's a short-term exponential calculation that institutions often use to gauge immediate trend health. It responds quickly to momentum. If price is consistently above the 21 MA, it acts as dynamic support. If it's below, it's dynamic resistance.
So you look for your candle patterns to form right off that moving average line.
You do. And finally, we have to mention Fibonacci retracements. It's a key tool for finding powerful corrective levels. The sources all emphasize the 50% and the 61.8% levels as the most important. Price often pulls back exactly to one of those levels before continuing the trend.
And if a 50% fib level also lines up with a previous swing point.
Now you've found a high confluence zone, and that's where the real magic happens.
Which brings us to the core strategy. How do you turn all this knowledge into a profitable decision? You need the trading holy trinity.
That's it. Successful trading is just aligning the answers to 3 key questions. 1. Trend, what's the market doing? Trending up, down, or ranging?
2, level. Where are the most powerful SR zones, MAs, or Fibonacci levels?
And 3, signal. Is a high probability candlestick pattern, a pin bar, an engulfing bar forming right at that key level, and is it aligned with the trend?
That synergy is what we call confluence.
Confluence. It's when multiple technical factors all point in the same direction. It's the professional filter. You don't need 5 things to line up, but finding 2 or 3 strong factors combined with a quality signal puts the odds decisively in your favor.
It's how you stop taking random trades and start waiting patiently for the A-plus setups.
Let's do a deep dive on the most effective setup using this. The pin bar strategy, the ultimate rejection signal. Remember, a pin bar is that long tail and small body.
The criteria for a quality setup are strict, though.
Very strict. It has to form on a big time frame, like 4H or daily. You have to trade it with the dominant trend, at least at first. And a pin bar with a tail that's 3 or 4 times the body length is exponentially more powerful.
So the psychology is that the long tail is a failed retracement right at a key level.
Precisely. It signals the retracement is over and the market is ready for the next big impulsive move in the direction of the trend. It is a sniper setup.
Okay, so you have that signal. How do you get it? There are 2 ways, right?
2 primary tactics. The aggressive entry is you enter immediately after the pin bar closes. Your stop loss goes just beyond the tip of the tail. The advantage is you catch the whole move, but the risk is a bit higher.
And the other one?
The conservative entry. This requires more patience. You wait for a 50% retracement of the pin bar's total range. So if the pin bar is 100 points long, you wait for the price to pull back 50 points into its range before you enter.
The advantage there is a much smaller risk.
A significantly smaller risk, which means your potential risk-to-reward ratio can be huge, like 5 to 1 or more. The drawback, of course, is that the market might just take off without you.
That's the painful part. Okay, let's talk about a more advanced strategy, one that involves trading market manipulation, the inside bar false breakout.
This is critical because it shows you how the big banks operate. They need liquidity, and they create it by hunting the stop losses of retail traders.
So the setup is you have a harami, an inside bar. Novice traders see that consolidation, and they put their stops just above the mother bar's high or just below its low.
Exactly. They're anticipating the breakout. The false breakout is when price breaks out for a moment, let's say to the upside. It traps the early buyers and hits the stops of the sellers.
But then it reverses.
It reverses and quickly closes back inside the mother bar's range. The liquidity has been harvested. Now you exploit the trap.
So you enter in the direction opposite the fake breakout.
Exactly. If the price faked a bullish breakout, you enter short. Your stop loss goes safely above the high of the mother bar, and because the market has already taken out the stops, this often leads to a fast, powerful move in your direction.
And the risk to reward on those can be huge.
Phenomenal. We're talking risking 50 points to make 250 points or more. You're profiting by following the smart money, not being trapped by it.
Okay. We can talk patterns and confluence all day, but none of it matters without this next part.
The unspoken difference maker. Money management. This is what truly separates successful traders from the ones who blow up their accounts. Even the best trading system will fail without a disciplined risk plan.
And the core concept here, the foundation, is the risk-to-reward ratio, RR.
You must determine this ratio before you even think about placing a trade. And the fundamental rule is you ignore any setup where your profit potential is less than what you're risking. You need at least 1-to-1.
But ideally more.
Ideally, you're aiming for a minimum of 2-to-1, but 3-to-1 is where the magic happens. This is what protects you from the emotional damage of a losing streak.
But let me ask you this. How can I possibly be profitable if my system only wins, say, 70% of the time? It feels impossible.
That is the beauty of this concept. Let's use the source's case study. Imagine you take 10 trades. Each one has a 3-to-1 RR. You risk $200 to make $600. Now, let's say you lose 7 of those trades and only win 3. Let's do the math. Your losses are 7 trades times $200, so $1,400 loss.
Right.
Your wins are 3 trades times $600. That's $1,800 won. Your net profit is $400. You won only 30% of the time, and you still made money. That mathematical certainty is what brings discipline to a very emotional game.
Okay, next up, the stop loss.
A protective stop loss is in order to automatically get you out when the price moves against you. And the crucial rule, based purely on psychological survival, is you never, ever use mental stops.
Why not?
Because mental stops are always defeated by human psychology. The pain of taking a loss makes people move their stop further away, hoping the price will come back. And that's how a small, manageable loss turns into an account-killing disaster.
That resistance to cutting a loss is the biggest killer.
It is. Finally, we have to talk position sizing. This is the real mechanism for controlling your risk. The best traders rarely risk more than 2% of their account on one trade. Beginners should risk no more than 1%, and that limit is rigid.
So you have to think in terms of dollars risked, not just pips or points. How do you calculate that?
It's simple math. Let's say you have a $10,000 account and you're risking 1%. Your max loss is $100. Your technical analysis says your stop loss needs to be 50 points away from your entry.
Okay.
You just take your max dollar risk, which is $100, and divide it by the stop loss distance, 50 points. That tells you that each point should be worth $2 for this trade. You then use that to set the correct number of lots to trade. It ensures you never risk money you can't afford to lose.
So to recap, we've gone from Munehisa Hama's 18th century rice markets all the way to modern technical analysis. We decoded the market's language through candlestick anatomy, the bodies, the shadows, the psychology.
I detailed the most profitable patterns like the engulfing bar and the high probability pin bar setups.
We established that vital structural framework, trending, ranging, and choppy markets, and applying that top-down analysis to make sure you're trading with the big money.
And we showed how to filter for the best setups using the Trading Holy Trinity confluence, and even got into tactical entries and how to trade against market manipulation.
And most critically, we underscored that disciplined money management, calculating your risk and RR before you enter, and using fixed stop losses. That is the real key to the castle.
Remember, trading is the skill. It's like learning a new language or getting a degree. It demands focused time, real effort, and rigid discipline. The sources have given you the map. Your practice and your screen time are the journey.
We've seen how professional analysis is all about combining these simple elements, trend, level, signal, not just finding one isolated pattern.
So here's a final thought. Considering the depth of planning that goes into finding a high probability setup using 3 or more factors of confluence, if the market moves strongly and decisively against such a meticulously planned trade, what does that failure truly tell us about the real forces of supply and demand versus our analysis? And how should a profitable trader react when their absolute best analysis fails?
It tells us 2 things. First, that the market can be unpredictable, and second, that your risk management system worked exactly as it should have. A profitable trader reacts by taking the small, planned loss quickly, moving on to the next high confluence setup, and never, ever abandoning their risk plan.
Exactly. Keep practicing, keep calculating, and remember the goal isn't making fast money, it's becoming an expert at what you do. Good luck with your deep dive.